Hello traders and welcome. This is Mike Hamilton from Trade Easy Way, and I'm looking at the daily on the Dow index. Now, a couple of things I want to just kick off with. First of all, if you really want to make a success of trading, you have to trade what you see first and foremost. If you've got a market that cannot support a price and is closing lower and making lower highs, making lower lows, you have to stick with the trend. Otherwise, there's no point in trading. If you're going to just constantly try and pick bottoms, you will never make a living out of this unless you are very, very good at trading reversals. Now, obviously, there is absolutely no reversal signal in this market. The only thing that this market's got going for it at the moment is that it is right at the bottom of the fib zone, and that's it. That's the only thing it's got going for it. What it's got going for the bears is the fact that it's a huge, a very, very significant sell-off. We've had 3 days of heavy selling now, and here we are with not even a tiny bit of any kind of reversal, not even the tiniest bit of bit of a dead cat bounce or any sort of short covering even into Friday. So let me get that very clear, very out there, and be very firm about that. However, let's just look at the fundamentals for a minute. So that's technical analysis. That's what the charts are telling us. On the fundamentals, at the moment, as we stand at the moment, we have seen a stream of steady improvements on the job level. We've seen a steady improvement in wage inflation. We've got a housing market in the US and the UK which is very buoyant, and overall, and we've got the GDP figure which has seen, despite a spluttering in the first quarter in the US, got GDP figures which have steadily improved. Now, what we've got next week on the data front is we have US GDP figures. We've got nothing on Monday. On Tuesday, we've got UK services and US consumer confidence. So I think what may happen with this market is, purely on the basis of the data that's due out, is we may just continue selling and drift into this zone here, which would mirror this level here. Now, if we do that and end up with a reversal pattern as we get into or after GDP figures on Thursday, we may then see a bounce, at which point I would want to get short, either here or ideally higher. Obviously, we have extreme RSI down here, extreme MACD, and support just underneath us, and because the ultimate, the fib support is right down at 845. So what I'm suggesting you do is, you've got 3 options. Either stay out and wait until we get data on Thursday and a close on Thursday. That's option number 1. Stay out. Option number 2, short. And so we could just try and wait for a pullback. The most obvious place is 800, and then see if we can come down here. So that would be 17.8. Option number 3 is you do nothing until Thursday, and then see if we get a reversal pattern, see if we get a mirror, see if we get some symmetry of this, and then start to push back. Alright, what am I going to do? I will wait till we get Monday. I'm going to do nothing on Monday, and then wait and see if we get any kind of recovery back to this level here, and a reversal signal on a 60-minute chart for me to short at that level, and then push that down. All right, so that's my view, that's my suggestion. You need to make your own decision and see if you're even going to, if you are going to engage this market, how you're going to trade it. Well, that's my suggestion. That's how I'm looking at it. Moving over to the DAX with the fibs on 83.43 and 12,420. So that's a massive move. So we have 1, 2, 3, 4, and then a capitulation here on the fifth wave down. So you can see 9900 is a key pivotal level, and we are 99.94. So same options. If you are a raving bear on this market, try and see how high you can get. 380 would be lovely, 50% retrace. It's not 50, that's 50% retrace of the last move, not the 50% retrace of this. 50% of that would be about 10,500. 50% of the last 3 days. The other thing about this move is, typically, if you look at the way the behavior of this market, you tend to get 3 days of one particular direction and then a pullback. You've got about three big days here before it pulled back, and then it dropped for another 3 days. So that's why I'm suggesting you might want to just hold back. If you are a raving bear, just hold back and see if you can get at least some kind of bounce. And 50% of that last 3 days would be a good place to get short. Otherwise, stay out. See if we get see if this is prepared to reverse and mirror what we have here for push up. I mean, what I'm suggesting when I talk about reversals, I'm not suggesting that this market could suddenly just go back and then start to reach for highs and run like crazy. What I'm suggesting is that this is a very oversold situation where the slightest bit of recovery could have the shorts running for cover and create a bit of a move to the upside, which would then let us get another leg down. So what to give you a longer term look at this, I'm suggesting that this is leg 1. Leg 2 could take us up to somewhere between here and here, and then leg 3 could then be down to here, and so on. So that's why I just think if you are going to short this market, just need to be very, very careful at this stage. It could just continue. We could have the slightest pullback, and we could just continue with the trend and just keep dropping and dropping and dropping. But that's the way I'm looking at this market at the moment. Right, flipping over to Forex. I think we've got quite a clear sort of line in these Forex charts. On the strong side, we've got the yen and the euro. And these are both low yielding currencies. So in an environment that is bearish, you tend to see a repatriation of low yield currencies because of the carry trade. So that's why you're seeing the euro and the yen being bought, because the repatriation, the fear in the market, withdrawal from the carry trade, and you're seeing traders repatriate carry trades. I'll talk about carry trades in the Traders Round Table. So on the strong side, we've got the yen and the euro. On the range bound side, we've got the pound and the US dollar. And on the weak side, we've got all the commodity currencies, including the CAD, the Aussie, and even the Swissy. So where does that leave us? Pretty the opposite of the Dow, where this Euro CAD could see a nice pullback back to that support and then a leg up to this fib level. So Euro CAD would be a potential buy at 153. Contrast that with a pound which has been sideways to bullish, and we're still getting higher closes in the pound US, which we'll come to in a minute. But the euro is the one that is steaming ahead. So let's move quickly over to the euro US. This is the fibs on the 2015 high and low, and we closed above the 200 EMA on Friday, so potential pullback is 11270, and because of that GDP figure in the second half of the week, I am just wondering if we are going to sort of draw the line at the 460, 470 mark, or 115, and then potentially roll over. But stick to the trend. You know, the trend is your friend until it ends, and that is a very bullish 3 days. Do not fight the trend because it will cost you. Just be very patient. Your call. Pound US, stay away. It's just very flat at the moment, and let's see if we're going to close above that resistance level and I'll buy a pullback. If we drop below 11156, I will short that. All right, I'm going to leave that there. Much more detail on Traders Roundtable, much closer examination of the potential for the rest of the week. But like I said, because of the way the data falls, I'm going to sit on my hands on Monday and then throw fibs across some of these charts in more detail and cross-examine this analysis again on the Monday Traders Roundtable. So join me for that and look forward to seeing you then. Enjoy the rest.